Sweet. Okay, great. We're going to get into it and get out of it by 12:30 so that we don't get in trouble like we always do. What is a yield curve inversion? Errol, go.
Ooh, a yield curve that goes inverted.
There you go. That's it, everybody.
What
That's
is it?
the
Interest
show
rates
for
going
today.
negative? I don't know. Educate me, Frank.
Great questions right off the bat. First of all, I love. Yeah, like push comes to shove. I'm gonna define the thing by just using the words in the question. It's like
Yeah.
when it's like, oh, like what's an instigator? It's a person who instigates.
Instigates.
It's a person who instigates.
Exactly.
So yeah, we're going to cover what a yield curve inversion is. I like that you already right off the bat bring up like, oh, maybe like yields are negative. Could have a yield curve inversion when they're negative, could also have a yield curve inversion when all interest rates are positive as well. It's honestly more likely that you have a yield curve inversion when interest rates are positive. This is probably one of the more likely situations to have a yield curve inversion, which by definition is simply when a shorter term rate is higher than a longer term rate. And
Quick
so
question.
go.
Right off the bat, this just reminds me of backwardation in contango. Now our front contracts are more expensive than our back one. Is there anything related right there at all, or we can just throw that aside? But I had to ask.
You're in the same ballpark. I would say like backwardation and contango are kind of like cousins, but
Mhm.
like yield curve, like those have to do with like the futures forward curve. Here
Mhm.
we're talking about like basic, treasury interest rates that have 2 years of duration, 10 years of duration, and 30 years of duration. But yeah, like you could call like there could be like a forward, that would be technically, Errol, like a forward curve inversion.
Okay.
If say in crude oil, let's say the futures that are expiring in March are priced at 90. And the futures that are expiring in April are priced at 89, and the futures expiring in what's the month after that, May, are priced at $91. That would be kind of like a forward curve
Okay.
inversion. Here, in terms of the yield curve, we're talking about just different durations of interest rates. And we're especially talking today about treasuries to kick off the conversation. So essentially what you have, and we've talked about this in the past, a treasury yield is the same across any of these durations. It's just a risk-free rate. Now, when you mess with like the 2 year versus the 10 year or the 30 year, you're going to get a different interest rate on what is kind of considered the same product. Now, when you have an inversion, Errol, that's when, let's, for this example, say that the 2 year is 1.5%. You would
Mhm.
expect normal environments, the 10 year to be higher than that, and the
Right.
30 year to be higher than both of them. But in this yield curve inversion, we're not seeing this now. This is just an example. You have the 2 year at 1.5%, the 10 year down at 1%, and the 30 year up at 2. Normal environment would be a rising yield curve. As I go out in time, yields
Okay.
get higher. An inverted environment, which usually signals economic strife or struggle, you'll see shorter term rates being higher than longer term rates. We on board with each other or what?
Pretty straightforward.
Got you. Now we're going to confuse the hell out of things and talk about a current yield curve inversion in the Eurodollar curve.
Okay.
Errol, have you ever heard of Eurodollars before?
I've heard of Eurodollars, but I've never done anything with Eurodollars or how to analyze them or what. But of course, I hear it on social media all the time.
Okay, cool. Everybody's talking about Eurodollars and Fed funds and all these different things right now because they're relevant. I've been trading these before they were cool, Errol. This was actually one of the first products that I did trade. Quick couple of things to get you over the hump here. Eurodollars pretty much have nothing to do with euro or dollar or foreign exchange or any stuff like that. A lot of people ask, oh, well, what's the difference between GE and 6E, 6E being the euro future? They're very different. They're not in the same asset class. Think of Eurodollars as just being a benchmark for short-term interest rates. Up until now, Errol, your mind has just thought the 2 year, that's short-term interest rates, okay? Eurodollars, we can get as short-term as like the interest rate for overnight lending today, like today into tomorrow. What's the interest rate for lending on that? But also, We can look at, what the short-term rate is going to look like in a couple of months from now, or 1 year from now, or 2 years from now. And so essentially we have products that create a mini yield curve before we even get to the 2 year, which is, for all intents and purposes until now, our benchmark of short-term rates. Do you follow me?
Sort of. So the Eurodollar is a good benchmark for short-term interest rates. So I understand that, but now I'm just like, okay, what do I do with that information?
Exactly right. Exactly right. You see this price thing, this thing that has just sunk over the last couple of months, and you're wondering to yourself, okay, I understand all the words that Frank just said. He essentially saying, Errol, trust me, this is a short-term interest rate benchmark. But now what am I looking at? Well, think about the fact that you get the interest rate from a Eurodollar. What the Eurodollar is trying to tell you the interest rate is going to be, this Eurodollar here is the most near-term expiration. So this is trying to tell you what the interest rate is going to be this month. Okay. That price of 99.30 is actually telling you an interest rate of 100 minus 99.30, beep, boop, beep, boop, beep, 0.7%. That's the interest rate you get. It's a little tedious math, but it's relatively simple to get your yield, your interest rate from the Eurodollar price here. Are we getting a little closer?
Yeah. So that makes a lot more sense now that you bring this up. So is this going to be always fluctuating? Tomorrow, can't we have the Eurodollar go up to 99.4? Within a day, it's already changing. Yeah. Okay.
Oh, it's changing continuously. Okay. Every single microsecond, this stuff is moving around until it expires, right? That's the name of the game in futures is like, okay, what are we expecting this thing to be, next week, next month, next year? And then when we fast forward to next week and the thing expires, it settles, it ends at what it actually is, right? And so this stuff fluctuates. The projections for where short-term rates fluctuate continuously.
How have I never learned this?
What's that?
I don't know why. How have I never learned this? That's crazy.
It's not directly relevant. You could definitely live a full life without knowing this stuff, but it's super intriguing stuff. And everybody always does I do this like once or twice a year. Like, hey, everybody, there's a lot of fun to be had in interest rates. And everyone's like, that is kind of fun. But it's hard to get on board with. But it is a really wide world of fun. Now, let's take it a little bit further. I think you're there with me. Yeah. Now we're looking at the forward curve for Eurodollars, which is essentially a yield curve here. And you can see each of these dots, Errol, is just the price of Eurodollars in the expirations that you can see down here on the y-axis, the x-axis. Oh my gosh. Down here on the x-axis. So this first dot is exactly the price that we were just looking at, right? You bring this all the way over, 99.30 is where it was at. You see, that's the price there. That's the March expirations this month for Eurodollars. And that's going to correlate, just like we said, to a yield of 0.7%. You see that this is a downward sloping Eurodollar futures curve, which translates to an upward sloping yield curve, right? And so you go out in time and you look at, let's look at right here, the December of this year, Eurodollar price is down at around $98, which is 2%. So they're saying right now, we're projecting interest rates in the short term to be 0.7%. Guess what? There's a Fed meeting coming up and everyone's talking about if they'll rate hike to 50 basis points or 75 basis points. The market is pricing right there in line with that in the Eurodollars here. But they're expecting by December of this year, hey man, we're expecting it could get up to 2%, and the prices reflect that. Now, what's interesting is look at that, man. Why is this curve? It doesn't just continue to go lower and lower. There's a hump to it. Before we investigate that hump there, Errol, is this all making sense?
Yes, this is starting to make a lot more sense and more questions are starting to come to my mind.
Dude, questions, hit me with them. Let's go.
Okay, real quick. Why do people speculate so much on the Fed then instead of just going to look at the data and then formulate an opinion that way? And whether is the Fed really all talk or not? Why not just go to data and keep it at that?
They're one and the same, my friend. They're one and the same. You speculate on these things. Everybody likes to talk on Twitter and everything, but this is where you go to commit this stuff to action. Now, we have to wrap up here really quick. You have more questions. We're going to do so much more stuff on interest rates. Interest rates are just heating up. The Fed and all this stuff is going to continue. But this is an inversion here, right? The prices are downward sloping, translating to higher yields. But at some point here, about 2 years out, you're seeing those prices actually come back higher, which is translating to yields increasing in this first part of the graphic, and then yields decreasing at some point. That's an inversion. You can trade this inversion pretty easily by buying the December 2023 Eurodollar futures, which is GEZ3, and also buying the 2-year Treasury yield, which is S2YH22. Now we're in the March futures there, because you see the discrepancy. The 2-year Treasury futures showing 1.6%, and those Eurodollars correlating to 2 years all the way up at 2.25%. We have ourselves an inversion. We'll talk more about this in the future, everyone.